All right. Good morning, everybody. So we made it through CPI yesterday. Today we have PPI. Yesterday's numbers really didn't shock the market. It wasn't a part of the drama that we saw yesterday. And all things considered, it's likely that PPI today won't be any better or worse. Japan down 0.25% with the NASDAQ. S&P basically flat with Hong Kong small caps. The Dow, it's not even at 0.25% yet. Just a market hanging out, waiting. We don't really have much of a discrepancy in the numbers or the projections. Once we get through production numbers at 9:15, we're pretty much done. The beige book, not expecting anything out of it. Of course, we wouldn't ignore a data print, but the Fed members we have today, not expecting any impact from them. And the beige book, unless we get some odd number, should be fine. So just watch the clock. The afternoon likely is going to be more about what comes out of the administration or just other headlines and not anything off the economic calendar. So far from the banks, we're not seeing, a complete wash. And, you have your celebrity CEOs like Jamie Dimon, they can really impact things with their bias or their outlook. And I haven't heard today's, but listening to what we got yesterday, it wasn't as poo-poo and negative as it could have been. And so that also isn't really tied to the moves that we've seen so far. But that was a significant change, right? We talk about the rate of change in the dollar and in yields. And that was a significant rate of change. You had the 10-year on the left, and then the dollar in the middle, the ES on the right. Did you feel that? We've got QRA coming at the end of the month with FOMC. Not really expecting any changes yet, right? The plan that Yellen was working still seems to be the plan that Scott Bassett is working. And until he starts to make changes, then it's just running the status quo. We can see that when changes do get made in the QRA, things tend to change. But still need to wait it out. The upcoming QRA, it's always a two-part event. We'll have one on Monday, the 28th, and then we'll have the final one on the 30th. Well, the 30th is also the FOMC day, so that week is going to be impactful. Also, August 1 is the tariff deadline. So, when you think about the upcoming catalysts and the wall of worry, that whole week, 28th, QRA projections, 30th QRA results and FOMC, and then August 1, the tariff deadline. Oh yeah, you like it. So, be mindful of what's coming. There was a slight roll down in the put wall. I think it's just the algos. I don't think there was a deliberate move, not on OPEX week, right? It's just it's possible but not likely. So, something expired yesterday, it opened up the next level and the algos moved the put wall down. It was a minor move to the downside. And we're still above the 0 gamma on the ES, but if you look at SPY, we're already there, right? We reached that level yesterday and then again last night. We're underneath the vol trigger, and yeah, it's where we are. So while the ES is unlikely to change these levels by the end of the week, the SPX and the SPY, a little more liquid in its options structure, may give you some cleaner results. We've been talking about that call wall for a while now and how it can provide a significant level of resistance, as we saw yesterday. It's where we expect them to monetize their calls, right? You get a bunch of call selling. It creates that sort of resistance or wall that we can't seem to get through. And that's likely it for the week when it comes to the upside, right? So sure, we could get some shock and awe numbers that propel us up through that level anyways. But what's more likely is we make it through the week maintaining this range that we're already in, or we expand a little bit to the downside. I know that sounds bearish, but really we're just talking about the same function and price that we've been talking about, right? And look at the last time that we were holding out in a range like this. Now, granted, I backed it up a little bit. This is really the range that I'm referring to. We peaked out of it, right, a couple of times and still came back inside. Well, that peak to the upside could easily have been to the downside and still maintain the range. So now with what we're at in this range, yeah, we had a little wick out of the top. We could just as easily have a wick outside of the bottom, maybe even come down and tickle that 20 period moving average. But as long as we come back in and we're still just wicking down there and not actually closing lower and putting in lower lows, then we don't have a change in structure yet. So this is likely the week, right, that we just keep bebopping here in this 100-point range, and that we don't get a significant sell-off or rally until after OPEX. Not unless there's some catalyst or, event that really triggers everything and gets us moving. One of the reasons that we're holding stable like this and are expected to hold stable like this is because of the options structure that's around us. And until that options structure expires at the end of the week with OPEX, we expect those guardrails to keep price in check. We have today's ADR levels, and since we're basically flat, there's no real edge towards one side or the other. But it is worth noting that we would need an inside day breakout to get to the lower ADR, but we don't need that sort of breakout to get to the upper ADR. right? Because it's inside of yesterday's range. Now, we already broke out of yesterday's range. We've been there, done that, and we came back in again. The easiest way to define yesterday's close is just to go out here to the daily chart and mark that off. Otherwise, when it comes to something like the futures, and even in equities too, you've got a 4 o'clock close, and then for the futures, you got a 4:15 close, a 5 o'clock close, and a 6 o'clock open. Which one of those are you supposed to mark? Right? That can get confusing. So just do whatever close the broker used on the daily and mark that close, and you're done. Simple as that. So you can see where we closed yesterday and that we went below it and we've recovered. We need to keep that now. We don't want to keep tempting fate. We're back inside the box, back inside the line, and we don't want to give it up again. If we do, we still have the focus of what we already put in this morning, and we have this level from Monday or Sunday night into Monday. This zone is what we want to continue to pay attention to. And it's pretty close to that 62.50 level. It's 7 points higher, but still it gets it done. Kind of a line in the sand. If we get through that level, we can get to the ADR half. If we expand below the ADR half, we can get to the ADR full. 62.11 cog line down there. But again, that's just expected to be like a wick out and then back inside the range again. We're not expecting to, get down there and continue to expand lower without some really good reason to move us through all the options that structure that we've built around us. That is a really wide channel today. So we're underneath the weekly floor pivot and we're back below it, the same level that we were on Monday. Being below the weekly floor pivot is a bearish bias. The expectation is, that we need to get back above it to be in a bullish bias. Today's floor pivot is slightly higher than yesterday's. That's bullish, but price opened underneath it. That's bearish. They cancel each other out. And today's floor pivot channel, that big red box here, it's a really wide channel. Wide channels imply that if we do attempt a breakout, it likely doesn't stick and we come back in again. Well, we already did break out and we already did come back in again. So far that's holding true. If we're talking about a top side breakout, we would need to run all the way back through both of those pivots, yesterday's midpoint, the open of the previous day, and then all the way up to the previous day's high, and then get above that and keep it. That's a lot of work. Really no expectation of that sort of behavior without a catalyst or a spark to get things going. And we look around today and kind of ask, what would that spark be? Nothing on the economic calendar would provide that. It would have to be shock and awe headlines, something that comes out in the news, right? It very likely wouldn't be just from 0-day flows and treasuries or bond vigilantes or anything like that, right? And even if the vigilantes did step in, what's the reason for them to get involved, right? So we're back to the idea that we just need a catalyst for the day if we're going to get anything done other than hold the range. Because of the wide day that we had yesterday, we're looking at a really wide range today on the floor pivot with the SNR levels. You can see that the wide day yesterday produced this really wide pivot system. We're not even at an S1 yet, and it's very likely that we don't get to that S1 and that instead we chop about between the R1 and the S1 level. And looking at the distance between the floor pivot and R1 and the floor pivot and S1, the pivot is still projecting a downside move. It's been projecting this all week. I've been pointing it out. It's just a math function, right? This pivot doesn't make price do anything. It just looks at what we've been getting, runs the numbers, and says it looks like the market is positioning for a downward move, and that it's easier to go down than it is to go up right now. That's it. And it happened to have been right this time. It's like deja vu at this point. The volume profile really looks a lot like last week's profile. If we do continue to move to the downside, we've got 62.50, and then below that we have a point of control from a couple of weeks back, right around that 42 area. 42 for a long time was a cog line, but we're talking, a long time ago, back in like when the ES was at like 36 and 38. You know what I mean? We're at 62 now, so it's been a while. But there used to be more cog lines than just 11, 32, and 92. Yeah, I've been running them since the 2800 ES levels, just for a little bit, right? 10-day, 30-minute volume profile with TPO. We did get that reduction we're looking for. We did see the point of control now moved up into 63.11, just as we anticipated. We don't have the point of control from TPO up there yet, but we expect that it will be by Monday at the latest. I don't think it's going to take that long to get there, but could. And we're already down to this level, which, I don't sit staring at this thing, but it's very likely that the point of control on the TPO was up there and that it moved down here because of our activity now at this point. But we can see that the volume isn't there. So we might have had the trades, we just didn't get the volume behind it. If we put in some work down here, it is likely to see that point of control on the volume profile come down and match the point of control on the TPO. But until then, we just don't have it. We could get the flow, between now and Friday to get that done, but it implies that we're going to sit right here in this little narrow 10 to 20 point range and get it done. And while we're, expecting to hold this broader range into the end of the week, I think it's an unrealistic expectation to believe we can hold something as narrow as a 20 point range into the end of the week. That's a bit much. We have a new VPOC from yesterday. And then this morning, we've got a really tight distribution. So if we do make a break to the upside to 63.06, yesterday's point of control, keep your eye on that, is very likely going to be a level of influence. You're going to want to know where that is. At the bare minimum, we could get a first touch play off of it, a couple points. It looks like it's really centered on the halfback too, which is nice, because then we just double layer the pivots. A little insight today on the TPO and the volume profile is this reversal didn't come with any real work behind it. And when we see this, it implies that it wasn't the ES that turned around here, right? It wasn't trading on the ES that turned it around. It was a comparative market, or maybe even an inverse market. So say, for an example, that 10-year hit a resistance level and rejected and started to fall when this hit support and bounced and started to rise, right? It would be that something else was traded somewhere else and reversed, which caused this to reverse. So it is worth noting this morning that this reversal didn't come with a push in this market. It came from a push from some other market. And you can hunt around on your own. Sometimes you can find it. A lot of times you can't, but it's always fun to hunt if you're a nerd. And I'm a nerd, so I'm not throwing stones. Still holding the range on the week. We are back below that Friday's close, but still nowhere close to the edge of the week. We've got plenty of room to move up or down and still stay within the confines of what we were expected to do this week. So, it may have seemed like we moved a long way yesterday. We didn't. We didn't go too far too fast. It doesn't owe us any sort of mean reversion. We're not stretched. We're not oversold. We're just holding the range. And there's nothing extreme about what we saw yesterday. We are still above the 10-day, not by much. Now that we're this close to it, it'll act a bit like gravity and we can swing back and forth above it and below it. Don't expect it to act as any support or resistance level. It's going to be just this zone that we cross back and forth through. And it's often a healing mechanism, right? That if we fell, say, a little rough down into the 10, that it can, catch price, hold us there, let us heal, because we can correct through time. And often we need that correction, stabilize and come up with a new plan. So at this point, the plan is waiting on OPEX and to help with not selling off before OPEX, the 10 stepped in. So we have those options of levels around us that's going to help buffer us from a big sell-off or a big rally before OPEX. And we've got the 10 below us to help with that as well. For the 10 week, we're still 3% above the 10 week. So nothing wrong there. The concern is, say that we make it through the end of the week and then we get into next week and we have one of those radical drops where we were 3.5 or 4% above the 10 week, and then we're suddenly 1 or 2% below the 10 week in one shot, that we didn't work our way down there. We just dropped down there like a brick off a building. That's the concern, but you can't anticipate jumping out the window. So we're just looking for it to work its way down there. The main thing is that we're not near it yet. So there's no structural support near us to hold us up or help us out. If we start to fall, we've got 3% at least to get to the 10 before we would expect to see any sort of pause in the move. China's up still 12% over a 5-day period, even though it's down almost 2.5% today. So, that was up 14.5% in a 5-day period. That's a bit extreme, and it's due for a little bit of pullback. looking at the yen, which is like a triple X China ETN. Then we got chips down, China again, China again, China again. But really, it stops at 0.5%. And within that structure, it's chips and China. Looking at what's up this morning, I mean, we got gold and gold miners. It's just not enough. We got financials, but not enough. Banks, again, kind of like financials, working in the right direction. They're just, we need 0.5%, right? So if we go to 0.5%, we've got nat gas, whatever. And then we got Bitcoin. So yeah, Bitcoin's a nice signal for risk, but it's not always, right? And the reason it's not always is because it's in the headlines. It's working through the House and the Senate with all these new bills and laws and regulations that they're trying to pass. And it will catch headline momentum that has nothing to do with risk sentiment. So, sometimes it's not a risk sentiment gauge simply because it's moving on headlines. So when you see it up like this and nothing else is up with it or nothing else is moving with it, check the headlines. It's very likely moving because of that and not because of some risk appetite. We got silver and gold, although gold needs to move a little bit more to reach our benchmark. It's moving in the right direction. A little bit of a gap up this morning. We'll see if we can keep it. Otherwise, we are working our way down after this nice run up. Got solar also up this morning. You don't want a rally day based on solar stocks and pot stocks and that sort of stuff, right? Just you don't want a rally on nat gas and solar. So small caps working their way up. You don't want a rally day on that either. We want to see some Mag 7 in here. SPY, QQQ, chips, cloud computing, consumer discretionary, that sort of stuff can really help for a rally day. This, not going to get it done. Worse is if we start to lose the Bitcoin, even if it was headline sentiment, they got it moving rather than risk appetite. If we start to lose that, then we really got nothing. Not moving to the upside does not mean selling off to the downside. Just kind of keep that in mind, right? I mentioned yesterday that I was looking for that fake break fast fail, that sort of rug pull move. And that's exactly the sort of move that we got. And this isn't about, haha, I told you so. It's the idea that we can sort of see these coming. And then we can prepare for it. And it lined up just like it was supposed to. That was the plan, right? Now the NASDAQ didn't really see the same pattern emerge, and certainly it didn't get the same depth of the drop. But when you're trying to set up for the day, it's the idea that you got to consider what day are we supposed to have, an inside day, a breakout day. If you're wrong, it's fine, but at least to start with a plan to define what kind of day we're supposed to work with. And then, of course, deal with whatever it is we get. So we are back above the 0 gamma level, and we're fighting with that volatility trigger. I'd like to see the levels update. I put in the data we had, but it won't change until till the AM founders note comes out, I believe. Then we'll see the new 1-day estimated move levels, and we'll go from there. All right, I've got a play called a failed flag set up, and it sounds a lot like what you would expect, right? So there's your flag ish. There's no reason to get pretty with this. And a typical flag would continue the move, right? We get a trend and then a base and then a trend. A failed flag goes the other way, and we end up forming a really big cup, and then maybe we get a handle, maybe not, but we're back up to the previous range. And at the moment, we have a flag, but the flag has gone on longer than it should have. If this was just going to be your typical flag and then continuation to the downside, we should have already continued to the downside, and we didn't. We had this beautiful reversal off the lows here, and now we're still in this zone. So it's setting up for a failed flag. The way I like to run these failed flags is by using that 786. It's a pretty good line in the sand. This makes for a nice intraday swing if you can catch it. If you get another shot at these lows, like around 1% or maybe 111, of course, that would be better. But if they don't give us that opportunity, if it doesn't go back down there, we're not going to get that shot. I don't know about you, but I wasn't trading at 2 o'clock this morning, right? I slept that off. So now the focus is get back through that 786. If we can get a candle close above it and begin this move up, then we've got the half as our target. And then, of course, once through that, we can focus on yesterday's high. We need some intraday price action to do some intraday measurements. We don't have that yet, so work with what we have. This is what we have right now, and this is the failed flag play. Now, it only took 1 day, but I've run this flag play where it's expanded 2 or 3 or 4 days to the downside, and then we build this base, and then we run right back up again. Right? It doesn't have to just be a single day. And you can get this same play even in a single intraday trading session. It doesn't even have to be a multiple day pattern. You can get it through the morning session. Like we had a flag set up yesterday. Of course, it just continued to move to the downside. It didn't give us a failed play and turn around and go back up, but it started to. When we were at that point yesterday, there's the same flag pattern, right? But it did what flags are supposed to do, and it continued the breakdown. If this candle had done like the reversal that I pointed out, and we came back in, that would have set us up for a failed flag, and we'd have tried to run it back to the top. Right? If it looked a lot like that reversal bar right there. But it didn't. It continued lower, and we had a continuation the way a flag is supposed to continue. But we didn't get a continuation this time. This pattern is like any other pattern. It can fail you. We can have this extended base and look like it's going to be a failed flag and then still come back down and break the 111 and continue to the downside. That can still happen. So, just be mindful that nothing is guaranteed, right? It's trading. Price can do whatever the heck it wants. But I like this pattern. Failed flag play is one of my favorites. And at this point, it's better than nothing because we don't have headlines worth a darn. Keep your eye on the news for PPI, but it's not expected to shock and awe. And then, get through a couple of the Fed speakers. Just watch for headlines that we didn't see coming, because I think that'd be the only thing that can really break this anticipated range into OPEX. Could make for some really nice iron condors. The range isn't all that bad. And we're halfway through the week, so you could get some decent credit for it. And if you can't get the decent credit on an iron condor, try a double diagonal using Friday, Monday calendar, and you'll get enough credit and you'll be able to use wide break-even levels so that you don't have to hug price and still, get a trade on with minimal risk. That's what I like. Double diagonal. It's like the Marcus play that I put together a couple years back. This is what I got for you guys. Be careful, be safe, watch the news. I'll see y'all tomorrow.